wow, that's a lot of people. Good morning, everybody there, down there at the end of the room. Still see me? Think I can believe you can. So multi-asset perspective on that. Clearly, we bring something different on the table. I hope so. So the E&S, Risk Club, and the multi-asset, what we decide to look at is more like in the next future, like the next 3 years. So when you see the numbers that I'm going to show you, keep in mind that we're trying to estimate the return potential of the different asset classes for the next 3 years. And of course, we do that because we talk with our clients. We want to make sure that they have reasonable expectation for their strategic asset allocation. And as you know, a lot of clients have still in US, this 7% in mind. So can we achieve that realistically? So the tilt we give to the presentation, as you probably have guessed by now, I'm coming from New York. And so that's why we have this tilt to the US investor to start with. So return expectation, historical return expectation is 10%. Funny enough, if you were paying really attention, not even the historical number is the same with the other presentation. But just because of the time horizon we took, it's slightly different. So here we're going to 1927, so 90 years of history. It's a multi-factor model. We use some machine learning techniques to avoid overfitting, and we come up with our numbers. As you see, you have US large cap, 10% historically, forward-looking 6.7. I'll give you a precise number, of course, as Raluca rightly specified in our presentation, is a distribution around the number, right? So we don't expect 6.7, but it's a reference point. So it's quite still high. It's lower than historically, and what is behind is a multi-factor model, usual suspect, interest rate, spread, PE ratio, and earnings. Plus, of course, we have some other assumption, like macro factor, GDP, and inflation. In our case, we decide to use an inflation, expected inflation for 1.8, and GDP growth at the global level of 2%. So probably the number that strike the most here, I'm sure some people are not really happy about seeing that, the high yield expectation. David is ready with the question, I'm sure. So the US high yield expectation, 2%, is lower than corporate and US bonds. So you would say, why should I take any extra risk to get that lower expected return? Reason being the spread. So we have at the level of spread that we think are kind of tight, and we'll go back to the, say, normal average. So when you do this adjustment, expected return for the next 3 years only, okay? It's not 10, it's only 3. And so the expectation is lower. So the way we look at it, of course, you need to take some risk to achieve your return. Equity, clearly. Not too much in spread, but yes, US bond and US corporate is still there to give you some return. So this is a model, and every as a model, you give the beauty of being able to test and see how the model worked in the past. Has been intuitive enough, kind of makes sense in the result. You see the numbers, like it's something that I can justify with the clients when I talk about that. And so this is the model historically. Every number, every bar you see there, it's the expected performance of the following 3 years, annualized, right? So you can see, as of today, the last bar is 6.7, and you see how it behaves. It behaves in a counter-cyclical way. So when the market is performing really well, then of course you adjust your long-term expectation of the next 3 years. On the lower side, if the market is doing really bad, 208, 201, of course you expect the return for the following years is higher. So you see that it's been working quite well in the past, and reasonably so. So as of today, we are at 6.7. It's a low number, but it's not extremely low. So we had return expectation in the past significantly lower, and we are not calling the end of the cycle or like, okay, next year has to be clearly a recession, a correction to bring this expected level of return and higher. So there is way to go. That's the message here. So we've been talking about equity. Let's move to fixed income. And in this case, as you know, I am from Italy. We'll move from a European perspective. Oh, sorry. I moved too quickly to the bonds. Stay with me in equity for a second. talk about the regional diversification. So we test the model on the US equity only, but of course, what about the other region? Right? What's the expectation for the other region? And we didn't touch to the other region yet. So looking at those numbers, we use the PE ratio as an indicator. You see the US equity is quite stretched. I mean, the highest 5% in the history, 30.5. So it's a high level. And you see the other market show higher potential. So if you think about a portfolio, of course, you want to be US equity because as I said 6.7 is quite good, but you want to be regionally diversified because the other region can give you even more. At least they have the PE on their side, so the valuation is on their side. While we know exactly the US usually has a higher PE than the rest on the region, so we don't expect everyone moving towards an average, we'll still see that the spread in the last years has been increasing. So when you think about this counter-cyclical component, you would expect the other market to do better and to catch up with the US. So there is a reason here to be diversified at the regional level. Emerging market, we kind of all agree there is a good potential there for different reasons, but also Europe, Japan, and Asia in general. So, as I said before, let's move to fixed income, this time for real. And we move to a Europe point of view. So those returns are all in Europe, and you see that we draw the line of the expected inflation, the forecast inflation by the ECB, and you see how difficult it is to find yield in the market that compensate for inflation. Actually, to be precise, there are a few cases where you still have a real return, positive real return. We know US govies doesn't give that. Hedging cost is really high. Now it's around 3-something%. But if you want to still beat inflation, there are asset classes that allow you to do that. And there are two good news here. First, there are still asset classes, spread, that allow you to beat inflation. And second, there is still a good reason to go to Italy. And you see here also what is a staggering number to me, was 10.7 trillion of money invested in negative yield and growing. Right? So this is something that we all need to be aware. It's a different game we're playing today. So we had equity, we had fixed income. What about multi-asset? Of course, we can combine numbers. We're going to make number up. So it's going to be the combination of this 6.7 and 3. But the good news is that when you look at asset allocation, and Raluca mentioned that, it's really valuable today because of correlation has been going down. This is monthly data on 1 year correlation, so short term, 1 year only. You see how it's going down. We are now close to 0. This is a combination of asset class, equity and bond, and the average of this correlation, right? So it's going down. So as of today, really close to 0. So a portfolio, multi-asset, yes, you will have a lower expected return, as we've seen. It's lower than historical numbers, but at least you can have that with lower volatility, so with lower risk. If you combine the portfolio correctly, and we all work with Risk Club to come up with the right strategic asset allocation for our clients, you can actually look good because your risk is lower in line with expected return and with the return in general. So we had the first two sessions, equity and bond, multi-asset. What else is left? We know that the return is really low, so we need to turn every stone to find some extra return. What do we find some extra return? In the alternative, and to be precise, in the alternative risk premia in our case. So we've been talking about that for a long time, and you see the return here, the asset class momentum is what we use as momentum in our strategies, and the other one is the Fama French classic model about alternative risk premium. You see, historically, it's been quite consistent, some exception, but positive. And you need to think about this one in terms of Sharpe ratio, so it's risk adjusted. If it's a positive number, it's good. It's something that you want to add to your portfolio because it's an alpha source that is uncorrelated from equity and bond. And as I said before, some of our clients still have 7% in mind or 7.5%. How do you get there combining what you have? is you need to add some extra alpha sources. The alternative risk premia, it's a good source. And given that here, we're trying to estimate the expected return of these asset classes, we made an effort and we try to calculate the expected return of this risk premium. Full disclosure is difficult, and there is a lot of controversial position on that. If the same model that we use to estimate the expected return of the standard asset class is good enough to estimate the expected return of alternative risk premium, and taking that into consideration anyway, but we applied the same model, and the outcome is, okay, the risk premia, alternative risk premia is a bit lower, but not significantly. So it's still there. And again, this is Sharpe ratio, so you can extrapolate that and decide how much risk you want to give to this alternative risk premium, and including your portfolio to come up with whatever is your target return that you need to achieve. Of course, that doesn't come for free. It's called is a risk, so it's a risk that you will add to your portfolio, and it comes in waves also. One of the reasons, most likely, why the momentum is still quite high, and as you know, we use this risk premium in our strategy, multi-asset, best style, AFI somehow, for a long time, right? But there are periods where it doesn't work, so in the last couple of years, we know momentum was not delivering a lot. That's probably why, one of the reasons, not probably actually, it's one of the reasons why the momentum is still at this level in terms of expected return for the next 3 years. To conclude, not a great news. We all know the past return, historic return is high. We're not going to have that in the future. That's agreed. I think everyone has the same view on that. Second, you need to diversify your portfolio more. There are opportunities out there at the regional level, and in general as an asset allocation with different asset classes because of the low correlation within asset classes. And third, look into alternative risk premia, because as of today, we need to achieve this higher return target. The only way to do that is combining different alpha sources, and the alternative risk premia is one of the important ones that can help us to achieve the target that the clients have in mind. Thank you very much.